What is the best entity to incorporate your startup? The consensus is that startups are planning on raising outside capital from venture capital firms, and startups investors should incorporate as C corporations instead of as limited liability companies, typically called LLCs. Welcome back to Entrepreneurship 101. Today's we'll talk about the best entity to incorporate your startup. Before we start the video, please like, subscribe, and press the bell icon. Many entrepreneurs are drawn to limited liability companies because an LLC is a highly flexible, customizable entity through which a company could set up structures similar to a corporation. Instead of issuing stock like a corporation, an LLC can create membership interests, including different ownership classes with additional voting rights. Setting up and maintaining an LLC can be more accessible in many jurisdictions. Given all this, why don't startup companies use LLCs more often? The short answer is that startup investors strongly prefer C Corp, primarily because of tax implications and a few other key considerations. Here's what you need to know to choose a business entity for your startup and whether to register as an LLC or a C corporation. Why do startup investors prefer C corporations over LLCs? Due to the tax implications, most venture funds and startup investors prefer C Corp. Tech startups choosing between an LLC and a C corporation will want to keep this in mind, as raising capital for a business registered as an LLC may be challenging. QSBS exemption for investments in C corporations. The Qualified Small Business Stock (QSBS) exemption is the most significant tax advantage to investing in startups registered as C Corp. As specified in IRS tax laws, LLCs are not eligible for this tax exemption, and LLCs that convert into C corporations are also not eligible. If you are already registered as an LLC, it may be possible in some circumstances to dissolve your LLC and transfer the assets to a newly registered Delaware C corporation. For an investment to be eligible for this exemption, under Section 1202 of the Internal Revenue Code (IRC), the stock must be purchased by the investor when the company was worth less than $50 million. Most early-stage startup investments qualify since typical seed round valuations are around $5 to $10 million. If the investor holds the shares for 5 years or more before selling, they can exclude 50% and sometimes 100% of the gain realized from selling the shares when paying their income taxes. Finally, the investors can also defer the recognition of the profits from their investments in QSBS stock on their tax returns if they turn around and reinvest the earnings into a new investment in a startup that qualifies as QSBS at the time of acquisition. LLC investments can create problems for nonprofits investing in venture funds as limited partners. LLCs can present a problem for venture funds with tax-exempt nonprofit entities investing as limited partners in the venture fund. Some venture funds may have pension funds, university endowments, and other nonprofit entities as limited partners. Investments in LLCs can trigger UPTI, unrelated business taxable income, for these nonprofit entities, which can undermine their classification as tax-exempt. Workarounds involve creating a particular purpose investment vehicle, but setting up these entities can be a big hassle and presents an extra expense to completing a venture financing. Investing in LLCs creates extra complexity for due diligence. LLCs are highly flexible and easy to customize legal entities. That is both a blessing and a curse. When it comes time to raise massive financing round from investors, LLCs are often much more complex to evaluate from a diligence perspective. The operating agreements for limited liability companies are much more flexible, whereas C corporations have conventional structures for issuing multiple stock classes to shareholders. VC investors will typically seek preferred stock, which enables investors to secure rights and privileges specific to the preferred type of shares they own, including liquidation preferences, rights to board seats, and pro rata rights to maintain their ownership percentage in future financing rounds and so on. LLCs cannot issue stock like corporations. Instead, LLCs grant units or ownership interests in the company and set up preferential rights that function similarly to preferred stock in a C corporation. Investors will often be unfamiliar with the corporate structure in LLCs, creating more work on their part to review and understand investment terms, and there will be more uncertainty around various deal mechanics. Keep in mind that with LLCs, there are often fewer case precedents for shareholder and investor disputes, so working outside the conventional C corporation structure can create uncertainty around what is judicially enforceable. Many founders are not aware that, as part of the terms of most venture financings, they are typically on the hook for paying their investors legal fees. Using an LLC structure for your startup is likely to substantially increase your company's expenditures on legal fees down the road for both internal counsel and financing-related legal bills. How does choosing LLC or C corporations affect my taxes as a founder? You might hear advice from other business owners about why LLCs are advantageous for your taxes. The profits from an LLC can indeed be treated as pass-through income flowing directly to your taxes. A limited liability company is similar to a sole proprietorship regarding how profit and income are taxed. This avoids what is known as double taxation, where your business profits are taxed at the corporate level. Then you have taxed again when you pay yourself a salary from your corporation. While this may sound like sage advice, it likely does not apply to most startups. As a startup founder, you should expect your business to take at least 2 to 3 years to become profitable, if not longer, meaning any concerns about double taxation are simply not applicable. Corporations pay taxes on their profits, and most startups don't generate a profit for several years. Read more about the myth of double taxation and startups. The reality is that when it comes time to file your tax returns, you won't be paying a high tax rate as a founder at an early-stage startup. You will only be able to afford to pay yourself a small salary, if any salary at all, until your company is generating revenue and has raised substantial amounts of capital from outside investors. Registering your company as a C corporation can result in potential tax benefits for founders. The QSBS exemption for startup investors discussed above applies to your founder's shares. If you hold your shares for the minimum holding period of 5 years before selling them, you may be able to exempt up to $10 million of the proceeds from selling these shares when it comes time to pay your tax bill. The business structure you use for your startup can have million-dollar implications for your taxes when it comes time to sell your company. U.S. citizens and taxpayers can use the QSBS exemption when obtaining stock in early-stage technology startups. Issuing equity to employees: LLCs versus C corporations. Many startups try to incentivize employees by offering them equity in the company as part of their compensation packages. Since startups often can't compete on salary with more prominent companies, they can retain top talent by offering generous stock options to early employees. The process of issuing equity to employees in an LLC is vastly more complex with an LLC compared to a C Corp. That's all for today. Thanks for watching the video. If you enjoyed it, please comment, like, share, and subscribe to our channel for more exciting content.